people often attribute Vietnam's extraordinary economic growth to its government. They can see how the Vietnamese government had initiated the Doi Moi reforms a couple of decades back, which moved Vietnam away from central planning and toward a more market-based system. This allowed private enterprise and foreign investments for the first time in decades. The results are then what we see today. Vietnam is one of Asia's new rising economic tigers. But amongst the results that we actually see, one of them has stood out: the United States. The US has been one of, if not actually, the biggest economic contributor to Vietnam. Yes, that's right. It might not actually be South Korea, neither may it be Japan, but rather the United States. It sounds weird. After all, the largest foreign investors in Vietnam come from East Asia, specifically South Korea and Japan. Here's a graph on the largest investors in Vietnam by total registered investment capital as of 2022. Here you can see that the United States is not in the top 10 largest investors. It's the 11th largest investor with a total registered investment capital of $10.4 billion. It's a substantial figure, but it is overshadowed by South Korea, which has a total registered investment capital of $78 billion. Singapore with $67 billion, and Japan at $64.4 billion. So, why do we say the United States is the biggest contributor to Vietnam's economic growth then? Shouldn't it be South Korea, Singapore, or Japan? Well, that's because while foreign investments are crucial, what's even more important than foreign investments is international trade. What is international trade? It is the exchange of goods and services between countries. It enables nations to sell their products abroad and buy what they need from other countries. For instance, Vietnam could be selling their products like textiles, agricultural products, electronics to other Southeast Asian economies. Likewise, Vietnam could be buying machinery, raw materials, or even military equipment from other East Asian economies. When they sell something, we call it an export, and when they buy something, it's an import. That's how international trade works. Now, the reason why we say international trade is far more crucial than foreign investments is because it drives sustained economic growth on a much larger scale. Let's take a sample of South Korea. South Korea is well known to be the largest investor in Vietnam, as we saw from the earlier graphs. The investors range from Samsung to LG Electronics and a long list of other South Korean firms. This helped pave the way for infrastructures to be built. Infrastructures like roads, bridges, or even digital infrastructures rose up. Then, factories followed. Samsung factories are seen in many parts of Vietnam, and each of these plays a crucial role in Samsung's overall supply chain. Finally, there's also labor. Vietnamese people are employed to work in construction of infrastructure and factories, as well as working inside them. This gives jobs to Vietnamese people. Basically, foreign investments contribute a lot to Vietnam's economy. But these foreign investments would not be possible if there were no international trade. How so? An important reason why South Korean companies invest in Vietnam is because they want to use Vietnam as a manufacturing base. They build factories in Vietnam to make their products, like Samsung phones, to be then exported to other markets. If they can't export the products to, say, the United States, then foreign investments would be limited, maybe to only cater to the domestic demand. This is where the United States comes in. It's the fact that it's one of the world's largest consumer markets. Here's a graph on the United States consumer spending, data from the US Bureau of Economic Analysis. Here you can see just how much the United States spends. This has risen every single year, and even though the COVID-19 pandemic occurred, consumer spending was still there and immediately picked up the year after. Now, this consumer spending is fueled by a lot of factors ranging from domestic products to foreign purchased products, and one of them comes from no other than Vietnam. The United States is basically an importer, or a buyer of many goods from Vietnam. Here's a graph on the US trade with Vietnam in goods. Here you can see that US imports, or the goods they buy from Vietnam, are substantial, and nearly every year we are seeing growth after growth. As of the latest year available for 2024, which only stretches the data from January to November so far, we are seeing US imports to be over $124 billion. This is no small figure. Remember the data that we saw earlier about the total registered investment capital? That figure only accounts for the total cumulative investment done. It's not something that happens every single year. South Korea does not invest over $78 billion every year into Vietnam. But the United States buys more than $100 billion worth of goods from Vietnam every single year. That is why we can say that the United States is by far the largest contributor to Vietnam's economy when we talk about foreign entities. Here's another graph on the largest exports by country for the year 2022. Here you can see that the United States far outshadows South Korea. In that year, exports to the United States amounted to over $109 billion, whereas South Korea only had imports from Vietnam of about $24.3 billion. China is a large market, but it is still nearly half of the United States, as they only had imports from Vietnam of $57.7 billion. So, what are the impacts of exports to these countries to Vietnam? Well, there are many reasons. We can again say it contributes to job creation, more infrastructures to be built, skill development, and overall modernization. But arguably, the most important one that international trade and exports bring to an economy is no other than US dollars. When Vietnam exports a good to the United States, like, for example, a Samsung phone, the United States is required to buy this good in the US dollar. The influx of US dollars then contributes to Vietnam's foreign exchange reserves, and its role is important for strengthening Vietnam's overall economy. It also has a role in paying imports. Vietnam, like many economies out there, imports a lot of goods and services from overseas. These range from machinery, technology, and raw materials from countries like South Korea, China, and Japan. If Vietnam did not have a steady flow of US dollars, then it would not be able to buy machinery products or raw materials to ensure that it continues to industrialize. It also plays a role in reducing external debt risk. Vietnam, like many developing economies, relies on external loans to fund large infrastructure projects or development programs. These loans are often denominated in US dollars. With a steady inflow of US dollars from exports, Vietnam can meet its debt obligations without excessive strain on its economy. There's a lot of benefits to having huge foreign reserves, but let's stop there and talk about why the US buys so many goods from Vietnam. There are many reasons for this, so let's start at the very beginning. The most important reason why the United States is a big buyer of Vietnamese goods is because they have several bilateral trade agreements. Agreements that helped strengthen the economic ties between the two nations and make trade easier and more predictable. For instance, the US-Vietnam Bilateral Trade Agreement marked a significant turning point. Once the BTA was in place, trade volumes jumped dramatically. Vietnamese products, especially textiles, gained easier access to US markets, while American businesses found new opportunities in Vietnam. Here's an overall graph of the US imports from Vietnam stretching back since 1999. Here you can see that US imports from Vietnam skyrocketed after this bilateral trade agreement. In just 4 years after the agreement was signed, US imports from Vietnam rose from $1 billion in 2001 to over $6.6 billion by 2005. Secondly, an important reason for the United States' role as an importer from Vietnam is actually because of these East Asian investors. Here's a graph on the Vietnam commodity trade for 2022. It's what they exported to the United States. Here, you can see that there's only two outliers when it comes to US imports from Vietnam. It's machinery and mechanical appliances, as well as textiles, footwears, and headgears. And you can already tell which companies it is. For instance, in the category of machinery and mechanical appliances, companies like Samsung and LG play a significant role. These South Korean giants have established massive manufacturing hubs in Vietnam, producing electronics such as smartphones, TVs, and home appliances. These goods are then exported to the United States, making Vietnam a critical link in the global supply chain for these companies. Then there's also Nike and Adidas, which rely heavily on Vietnam for their production. Many of these companies are headquartered in the United States or have strong retail presences there. Vietnam has become a go-to destination for these brands due to its cost-efficient labor force, skilled workers, and well-established supply chains. Products made in Vietnam are shipped directly to the US market, meeting the high demand for quality yet affordable goods. Thirdly, another important reason for the United States' role is the fact that Vietnam's national currency, the dong, is very weak. Here's a graph on the official exchange rate of Vietnam's national currency to the US dollar. Here you can see that in every single year, Vietnam's dong continues to weaken against the US dollar. The reason why this is so important for Vietnam's exports is because when the dong weakens, the cost of Vietnamese goods becomes more competitive in international markets, especially in the United States. A weaker currency means that foreign buyers, like those in the US, can purchase more goods with the same amount of money, making Vietnam an attractive source for a wide range of products. For instance, let's say a pair of shoes made in Vietnam costs 500,000 Vietnamese dong. At an exchange rate of 22,000 Vietnamese dong to $1 US, the price in US dollars would be approximately $22.73. Now, if the dong weakens further to 24,000 Vietnamese dong to $1 US, the same pair of shoes would cost only $20.83 for US buyers. This price reduction makes Vietnamese goods more appealing compared to competitors, such as shoes made in China or India, which may not experience the same currency devaluation. Now, before we end the video, it is important to also know that there might be problems in the future. President Donald Trump has been voicing for tariffs on imported goods. The reason being is because President Trump aims to reduce the US trade deficit and protect American industries. He often criticized countries with which the US had large trade imbalances, and that includes Vietnam. Here's a graph on the trade balance between Vietnam and the United States. This graph covers both the imports and the exports. It does not only cover the exports from Vietnam to the United States, but it also covers the imports, when Vietnam buys goods from the United States. Here you can see that Vietnam does not really buy a lot of goods from the United States, but it sells a lot of goods there. This is what we call a trade surplus. A trade surplus occurs when a country exports more goods to another country than it imports. This big trade surplus of Vietnam could be in trouble if Donald Trump were to initiate tariffs, as it would reduce imports from Vietnam and push economic challenges to the Southeast Asian economy. But in any case, even though there might be challenges, the US would still arguably be the largest importer. But anyway, do let us know what you think. Thanks for watching.